So, I've noticed a lot of people are creating tier lists, and seems to be a recurring trend in the video world for people to create such lists to rank or rate movies, TV shows, people, channels, etc. Mostly opinion with usually little facts. I noticed there's one type of tier list that doesn't exist, so I figured I would make one on stocks. This is the list that I've created from scratch. These are some of the most well-known public companies tradable in the United States markets. All of the most valuable companies in the world are in this as well, and I've tried to make it simple by alphabetizing all of them. Disclaimer. Obviously, I wouldn't say very risky depending on the skill or knowledge of the individual recommending stock. Buying, speculation, analysis, etc. is inherently risky, just like almost everything else in life. I mean, nothing has no risk. Everything you do every day has some sort of risk involved. Of course, this one. Do not trade more than you can afford to lose. That should be a given. I mean, unless you're careless and are willing to lose it, then sure. But don't buy something if you aren't willing to take the risk. Also, I'm not professionally licensed. Although I do plan to be in the future. Currently, I'm not, so this is not technically investment advice because I'm not licensed professional. Yeah. So here's again all the companies. We have S, which is buy this like right now. Why don't you own it? Buy it. Buy. Pretty much guaranteed to go up mid to long term, and should be stocks that you should hold for your life. A tier will be stocks that you should definitely have in your portfolio. I can almost guarantee that if you have a retirement account, the stocks that are in here are definitely not retirement account, because portfolio managers know that these companies hold inherent value and are worth the buy and hold. Bravo B. These companies in this tier will be stuff that is good to have, and I'd recommend having it. Whether it be for buy and hold long term or buying just for the dividends. There's little to no risk in B tier. Alright. C. There's stocks that probably will be small caps. Companies may not be around for our lifetimes, may not survive the economic and political, etc. risk and changing of times, but they do have potential to grow in value if you're willing to take the risk. D tier, you might as well be playing a slot machine, because it could be 50-50, and obviously the house always wins. So the advantage is against you, so you'll be playing the odds, most likely, and not stuff that I or financial advisors or investment advisors would recommend buying, unless you're willing to take high risks. So, I'm not saying don't ever buy the companies that will be in this tier, but I'd suggest not buying companies in this tier. And then F, penny stocks, don't buy them. Unless you legally have insight that it has some value that isn't there or the people don't see, do not buy these and run. Alright, so figured we can go down the list and so many good choices. Figure we start from the top of the alphabet and then see where it goes from there. So, we're going to start with Abbott. Abbott, the promise for life. Figure we start with Abbott Labs. Here we go. So, Abbott, technically, Abbott Laboratories.
In my laboratory.
Yep. They mainly focus on artery opening stents and heart repair products. Wikipedia. They never lie, right? Anyways, based out of Abbott Park, Illinois. Coincidental name. Yep, trade on S&P 500, S&P 100 components, so they're one of the biggest medical companies in the world. Healthcare industry, they do pharmaceuticals, medical devices. And then Miles White, this man, was the CEO. He's been in the company for a couple decades, and he's getting taken over by Robert Ford. I want to say in late March. Took his place. Yeah. So for all you history buffs, it was founded by physician Wallace Calvin Abbott, 1888. And there are some of their well-known products that I'm sure you've heard of in commercials, advertising. Pedialyte, Similac, Ensure, Glucera, Zone Perfect, Freestyle Libre, iStat, MitraClip. Here's a cool spin-off that they did. Yeah, in 2004, they spun off Hospital Products Division, Hospira, great name, with 14,000 employees, which is later bought by Pfizer, one of the biggest medical companies in the world, obviously a Dow 30 component. And then, huge deal here in 2011, they separated into two companies, one being Abbott, Abbott Labs, which has their nutritional products, and the other one, AbbV, in 2012 got its name. Yeah. And these are just Wikipedia numbers. I wouldn't bet on these numbers being precise, but as you can see, revenue growth almost every year, except it looks like 2008-9, or around 2011, it dropped vastly. And as we know, that's when the Abbott Labs and AbbV separation happened. So it makes sense. But you can see after separation, growth every single year, and revenue, net income kind of fluctuates. Yeah, and employee growth every year, which is expected. And so here's just quick tidbits about the new CEO, Robert Ford. Went to Boston College, Cal Berkeley, been with the company for a while. And he, yeah, well, can't go wrong with Yahoo Finance. Yahoo Finance. Abbott Labs. Currently, as of June 13th, which is Saturday in 2020, the share price was $89.02, up 1.41% on Friday. Here's a nice daily chart, which pretty much tracked the markets. The markets were kind of like this: down, up, down, and then close the day up. But here's a weekly chart, so you can see it's pretty flat on the week, other than Thursday when it dropped a ton. The entire market was down that day anyway, so on the monthly, down a little bit. This is where you can see the COVID-19 hit, which pretty much nearly every company got hit. They dropped from the 90s to about 60s, so lost about 33% of its value. Now it's back up to normal almost already. You can see the max goes down to 1980, where they were less than $1 a share. That would have been a good buy. Just even if you managed to get a $1, that'd be 8,900% ROI. And yeah, 40 years, but still huge gains. So it's $157.5 billion company, so obviously a large cap to mega cap. Consider 52-week range. They're in the upper range, the 52-week range, you can see. Earnings, we'll talk about earnings later. Dividend is 1.64%, which is respectable. Not bad for healthcare company or pharmaceutical. Volume is 4 million, which means about $36 million worth of shares were traded Friday, and an average of 10 million, so nearly $1 billion of shares are traded daily on average. Here's a 1-year target, 100. Talk about targets later. Earnings per share is $2, which is very respectable. That's solid earnings per share in 12 months. So about 50 cents a quarter, which is again pretty good. PE ratio is above market average, but I'd say that they're still growing every year, so that's acceptable for it to be above market average. Their beta is actually below the market average on a 5-year monthly, which is impressive beta, meaning that it's that much less volatile than the overall market, but 0.03. Alright, we'll look at statistics. So it looks like good. They're a normal company that ends on the last day of the year. It's always a good thing. Profit margin, solid. That's if you can get double-digit profit margin that's essentially after taxes are paid, the percent of the revenue that the company keeps. Really good. Revenue this per year is $32 billion, which is a large sum of revenue that they're bringing in every year. Revenue growth year over year, despite COVID, their revenue is up. Right. And then quarterly earnings was actually down year over year, so they lost money And I would assume that's due to all the research and salaries, etc., that they're having to ramp up for combating COVID. They have just over $3.5 billion of cash as of most recent quarter. Very nice. I mean, they could go and make acquisitions if they wanted, but just meaning they have that much more money to for research and data, etc. Um, yeah, total debt 18 billion, which is a lot. Um, they did acquire. Well, um, book value is 17, which is pretty good. Uh, it's good that it's a positive number. Yeah, 89 to 90. Um, so that nearly one less, just over 1/5 of a book value to share price. Yeah, that's not bad, I guess. Operating cash flow is really good. This company has plenty of cash at the bank. Uh, so I definitely expect them to be around for a long time. Maybe if they're making some more big acquisitions in the future, they could very well easily do so if they choose. Financial. Alright. Can't go. Financials. There we go. So, well, look, our favorite numbers are the top line and bottom line. Top line is revenue, so as you can see at 16, 21, 27, 3, 30, nearly 32, so solid growth every quarter. And top line cost is increasing along with it though. Gross profit is increasing every year, which is good. And then of course, everyone's favorite number, net income. So this is a billion, so 1.4 billion, and then it dropped 407 million up to 2.3, and then last year, this is yearly, so they brought in 3.69 billion net income. Awesome. Awesome. I mean, it's almost a time and a half what they did a year prior, so can't complain with that. Now we can look at quarterly. 7.5 billion, 7.9, 8 billion, 8.4, and then down last quarter. So first quarter was kind of not as good in revenue. I'm sure them, Abbott, just like the vast majority of the companies, lost, or not necessarily lost, but didn't make as much revenue as normal, uh, whether it be directly or indirectly due to COVID-19. That that income go 672 million, 1 billion, 960 million. Christmas quarter 1 billion and 500 million. So they're making profits easily. It's easy for them. Breezy. No challenge. They're making money. Here's a cool little chart. As you can see, they're growing revenue every year. Quarterly fluctuating. And then here's the earnings per share. Again, take every earnings statement during political and financial crises with a grain of salt. So don't necessarily count them out just because they didn't do as well one quarter as opposed to a normal quarter where there's not global crisis happening. We'll look at Edgar, which you find on SEC.gov. Edgar is pretty much where companies will report all of their documents, their financial documents, or just company documents for making executive changes or corporate actions, etc. I'm not going to look at all of these, but I'll look at some recent ones. I already looked on this one, SD, which pretty much just talks about this. Conflict minerals, which they mention. These are conflict minerals. I don't know if it's all of them, but it's some. Tantalum, tin, tungsten, and gold, or 3 TGs. So it just says that these are minerals that they use in their products, uh, drugs, etc. And they're just saying that they are following by the rules and that they require their suppliers to disclose the presence of any of the conflict minerals within the supply chain. So they're just covering themselves, making sure that they're being safe, as well as their suppliers, which is smart. You don't want to get sued by businesses or and consumers, which consumers, as we know, love to sue big corps because they can get that paycheck. And of course, stress and whatever. Here's the document, the 10Q, which was from April, pretty much right here, which is quarterly. So again, first quarter of this year. Very fun document to read. Very fun. You can see we already saw these numbers, but here's just another location and format to view them. You can see their net sales were up, so again, revenue was up, and then as we already saw, the earned and new earnings were down, so they made more money total on the quarter compared to the last year, but their net income dropped because, as I would assume, they're spending more money on yes, research and development. They didn't spend as much. Amortization of tangible assets, interest, and numbers. Right. Oh, this is fun. No, that's not fun. This is fun. That's not fun. This is fun. Alright, we can see here is just a gorgeous breakdown of their product categories and how much they made or lost based on the category compared to last year. So here's, let's see, I'm not going to go over all of them, but let's see, they made the most from medical devices category, and as you can see, they make more money internationally every year. They're more internationally based compared to the United States, where, as we saw, they're based out of Illinois. So yeah, but nonetheless, they made more money. And their most popular category, which is medical devices in the U.S. No, they made less money in the medical devices in the U.S. this year than last year, but internationally, in medical devices, they made more this year than last year in the first quarter of this year. Total, it was more revenue from med devices, their most popular category, segment, and whatnot. Diagnostics, which is labs, molecular, rapid diagnostics, overall slightly down than last year, but it's not by that much, so that's not something that I think the board is too worried about, although I'm sure they're talking about it in meetings. And also, let's go back to med devices that I mentioned, which includes heart failure, vascular, diabetes, some of the biggest medical problems that people in the world have. Yep. And then, yeah, I'm not gonna go over everything, but overall, it was up this year from last year. Can do the math. Nothing like math, am I right? Minus 7,585 equals this. 7,535 equals, boom. That sounds about right. They were up 2.5% in total revenue this quarter, this past year, compared to the same quarter last year. Alright. Here's another way. So, same document, just different format. Also from Edgar. And then, oh yeah, I just wanted to talk about this. So, yeah, so I do remember when this happened, back in 2017. So not even, or actually just over 3 years ago, when they bought St. Jude Medical. So yeah, Abbott bought St. Jude Medical for their dollar. Oh, no. Well, I want to say it was between 17 and 25 billion or so. Nice little sum of money. So, St. Jude Medical mainly focuses on pacemakers and implantable defibrillators. So, I think it was actually a perfect fit. Two companies that don't have businesses that are tightly intermingled, and it allows them to diversify into the medical industry. So essentially, it was a merger. They wholly owned them. Oh yeah, and they took up around $5 billion of debt from St. Jude, and it just broadened their portfolio. Like it says here, strengthens their Abbott portfolio. Um, yeah, I think it was a great acquisition overall. As we've seen, their revenues have grown yearly. Their net income, uh, aside from COVID, has pretty much grown as well yearly. Um, Fidelity, great broker. They have great products as well. Can do some research on Fidelity. And yeah, this will always happen. You'll see that power price is dropping drastically. The volume will go up a lot, meaning that a people, institutional investors, and mostly, and then some retail investors are jumping on the opportunity to get this at a low price, combined with the fact that since it's cheaper, the shares are cheaper, the volume is higher because, just common sense. The cheaper it is, the more you can buy. Alright, and then here's just showing their history of earnings per share. Met, yeah, pretty much met except Q1 they actually exceeded, because I'm assuming the analysts didn't expect them to report as much due to COVID. Yeah, you can just, I have an account with this company, so you can see all this data. A lot of this data you would not be able to see if you didn't have an account. Here's sentiment. Data thanks to Recognia. Don't know who they are, but thanks for the sentiment. So short term, I'm assuming that a lot of companies are gonna have weak sentiment short term, so take that with a grain of salt. And yeah, definitely agree with the strong mid and long term. Fundamental analysis based on their fundamentals, pretty much all high. Their valuation is even kind of close to undervalued, which a lot of analysts and me personally agree with. Growth stability is pretty low. Yeah, I don't know if I agree with that. I do think that they have lots of room to grow, especially if they can get their COVID products out and distributed more and become more prominent in the medical field. Here's the top exchange traded funds that are holding Abbott. iShares is one of the largest ETF companies in the world. This one fund is 13.7. That's pretty high percent. So I don't know if I necessarily consider this fund diversified. If they have that high, I would hope that they would at least actively diversify that more. But nonetheless, I don't hate them for it. But I'm not sure why they have such high percentage in any one company. And then yeah, here's all the other funds. Fidelity, this Fidelity fund. See, that's pretty smart. Only 3.6% in a healthcare index. Yeah. Here's some of their competitors. This is a pretty cool graph. Shows the competitors on a yearly basis. So Abbott is up nearly 9% on the year. The entire healthcare industry is up about 50% more than them. And then all their major competitors, not all, but most of the major competitors are down a lot. Boston Scientific, Medtronic, Baxter, ESA. Betas are, well, very diverse. And it looks like Abbott has far more shares than all their competitors too, which is pretty interesting. Yeah, I really like this website, mainly for screeners. I'd recommend it. So yeah, beautiful bar chart, candlestick chart, showing them since 2019 of September. Yeah, beautiful. A lot of numbers again very solid. S&P 500. Yes, you can buy options. You can short them. Simple moving averages on 20 and 50, and goes down to 200 is up. Here's the number of volumes we already talked about. Down 3.5% on the month, down 1% on the week. So short term they're down, but pretty much any long term, you can look at it starting from the quarter, so mid-term to short term, they're up. Sutter zone only 1%. It's kind of a respectable but low percentage. Institutional ownership 76. That's pretty high. I mean, average wise. Earnings per share expected to grow in the this year, next 5 years, and they've been growing the past 5 years. Sales are expected to go up. Earnings per share quarter to quarter down, which again, COVID. Here's some news. I'm not going to read all of it, but there's news if you want to pause and read it. And then here's insider transactions. Honestly, I don't ever even care if it's a sale or option exercise. God, doesn't really mean company's good or bad. It could, but it doesn't necessarily, because sale can be for any reason. Maybe the vice president or the CFO or SVP just needed the money, or maybe it could just be an option exercise where it's forced to liquidate. So unless it's buying, I wouldn't really care that much. Then here's market beat, another good, uh, another good source. As you can see, back in 2017, their earnings per share was positive. I don't know this company, have they ever lost money? Oh yeah, so on this page on earnings, just so we can track as far back. So here's the estimates in the future. Look at the average. Looks like they're expected to grow from prior. So these are quarters. Eventually, they're going to be expected to make $1 per share per quarter, which is amazing. What is this estimates? This is the past. So as you can see, they're generally accepted accounting principles. Earnings per share were higher than what they reported, so revenue near around $7 billion every quarter, more or less. Here's the past. Blast from the past. Earnings per share every quarter. 2016, 15, 14, 13. Profits. 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 Oh my god, you can go back to 2012. It's on EPS. Profits. Profits. I don't know if they've reported a loss that they have. I can't go back that far. Or I could, but I don't feel like it. I don't have the time. I don't want to. MSN. Sponsored by Microsoft. Yeah, their data's okay. You can see this is as of yesterday at Eastern time, around 8 p.m. They updated. That's really rough. Mainly reason I use MSN is this analysis. Gotta love charts. Look at that. Book value per share is growing. This is again a dot. That's a dot. Oh, cool right there. Yes. Book value per share growing. Well, their debt to equity is flat, which means they're becoming more valuable. So essentially, their value is outgrowing the share price. So it's great value for us, stock. Debt to equity is a little bit more compared to the industry. Value way more than the industry, which is awesome. But also, I'm sure their price per share probably costs more than the average anyway, so don't compare these two. knowing the internal data. Here, management. I love this page so much because it shows this, which is something which I think is vastly undervalued. Revenue income per employee, 34,000, much more than the industry, but it was 36% or so. They're making decent sum money per employee. Only thing is, I would think that Abbott employees make high average income, nonetheless. Tip ranks. So, neutral. Tip ranks is, I would consider a harsh grader of companies. So for them to be a 7 neutral, or for anyone to be anywhere from 5 or 6 and above, is pretty respectable from tip ranks. Looks like hedge funds have been buying. Bloggers don't never buy based on bloggers. Like, not saying they're bad or wrong, but definitely not a source to base your opinions on. But hedge funds, yeah. Insiders are selling, analysts are buying, technicals are good, fundamentals, analysts. And I can't see the specifics of these because I gotta pay. Yep. But you can't see the analysts have been mostly positive. Look at these. The was that average this to be high 90s, and overall 103, which is, you can see, 16% upside. So that's, again, 12-month target. So in 1 year, about average 16%, which, if you can get 16% a year, that's incredible. I mean, we're talking about for the average investor, American, etc. Investors. Yeah. Here's some stocks that people who bought Abbott, stocks that they also bought. So pretty much, if you're buying Abbott, you're buying the other biggest companies in the world. So you're in good hand, good company. You're in good party. You're in a good party. Enough. Bloggers don't care. Insiders. Says we already knew a bunch of sells. Here's a buy in last month. Their vice president. Uninformative buy, so he bought it on his own, supposedly. Yep, then buys, which I can't see the numbers of. News. News mostly affects retail investors who will buy a lot of times unjustly based on just news, whether it be a good or bad report. They'll just hear it, and media mind controls people so much that they'll hear breaking news and they'll think that, oh, gotta buy now or gotta sell now based on that news. Never play based on news. You can play based on investors buying or selling of news, but don't go on your own and buy or sell something because of the news. Yeah. Hedge funds. Yeah, Ken Fisher. Buy Ken Fisher. Get ads for them every day. It's desperate for it. Nonetheless. So he has decent sum. Oh, that's cute. This dude has a little $5 million in it. That's cute. Ray Dalio, one of the largest hedge fund investors in the world, has only $4 million in his company. Why? Bruce, who's this almost 5% of his whole company, is $20 million. Yep. Charts. Dividend growth, 2%, 2, 1.64. Moderate growth growth based on dividends. You missed the dividend next day. You're watching this video as of June, in mid to late June, I'll be releasing. Similar. Here's similar stocks. Alright, Morningstar. I've had Morningstar account. I'm not gonna comment on how good or bad they are. I'll just say I don't have them anymore, so I can't get all this details, sweet details on Morningstar anymore for their data for companies, but I can get the general consensus. And if you do have Morningstar, this is a hit or miss. Little graphic and research, etc. that they do. I'd say more often than not, their ratings on value is correct, but again, don't base your buying and selling on any one or limited number of data and research. Stuff we already knew. Yeah, again, 60% of their sales are international. So of course, with that being said, that means that they inherently have international risk. Valuation. I don't think I can view this. Can I? That account. Stuff we already all knew. Dividends, ownership. Why not? Again, these are all funds that this all of them. Top 20 funds. Ooh, Morningstar rating. Spiders. Can't go wrong. Spiders Vanguard, one of the most well-known fund companies in the world. Institutions. It's pretty cool. Vanguard, BlackRock, which is, I want to say, that one of the largest most assets held in the world. One of. Executive. Oh, cool, you can see all their executives. Can I sort? Oh. So they're former, that's probably former CEO was raking in. Oh, come on, it's outdated. And I don't have Morningstar anymore. 2016. We figured they could always put it where this is fixed, right? Because it's like a scroll across here, and who the heck was on the left? Nonetheless, look at this every year normal. Only brought in 27 million last year. Jeez. Stock awards, payout, other bonus? No bonus? Dang. He couldn't even get a bonus. Alright, nonetheless. Board of directors. Here's all our directors. Here's the current CEO as of a few months ago. Committees. Well, look at all these cool committees. And then transaction history. Buy. Where's the blue? Buy. And as you can see, there's no buys when we clearly saw there were buys. On other sources. And again, that's why I don't understand. Alright, this is not a good research tool at all. I just thought it'd be fun to throw in there. Google Trends. Something a lot of people don't know about. I just was curious. Typed in Abbott. In the past year, who is most interested in Abbott on Google.com? Ireland. US, of course, UK, Costa Rica, Australia. And then, of course, what everyone cares about, coronavirus, COVID test. Yeah. I'm kind of curious, what about city? What city is most interested? Minneapolis, most interested in Abbott in the past year. I would venture to bet that's the same in the past month. No, I'm wrong. Fort Worth, Texas. Dallas, wow, Texas. Why are you so interested in that? That's weird. Nonetheless, and of course, you're not doing your research if you're not on Twitter. Twitter. So I found that a lot of companies are not hurting themselves at all. If anything, it's boosting their publicity and visuals on planet Earth by being social media integrated. I'm not going to go over all their social meds, Abbott, but I will go over Twitter, one of the largest social media brands in the world. So yeah, as you can see, they have 100,000 followers. Oh, look, Jim Cramer follows them. Here's a pinned post from 5 hours ago. Is that pinned? No, but it's from 5 hours ago. 21 likes. Should we like it? I like it. Breaking. Yeah, yeah. Thank you, COVID. Thank you, team. MV. I'm just curious. Let's look at one of the competitors. Sanofi. 77,000 followers. So Abbott is more popular Twitter-wise than Sanofi. Nonetheless, it lets you know that a lot of people know about the company. I'm sure a lot of employees just follow them by default, or people that have used their products, like medical, etc., follow them, or investors alike, just to get the news updates. And then I would bet you that their follower count has gone up a lot in the past several months due to COVID, and due to the fact that they're making one of the devices to help detect COVID. Yep. Then, of course, you are also not doing your research if you aren't going to the company's website, Abbott.com. Oh, look, this woman has a mask. Look, some vials. This is Abbott.com. Here's their product that they make to detect COVID, which they released earlier this year. Is their website interesting? I don't know, but I do like this photo right here. Can I save the photo? Will I save it now? Look, they're on all social medias, Instagram, Twitter, etc. 2020, and they've even updated their cover right here, which I'm always a fan of when a company updates this. 2020. I'm not gonna spend forever on their website, but we're still at the homepage. And then here's the new product. ID now. Trademark. Trademark. So yeah, as a leading point of care product, you can detect positive results in as little as 5 minutes, and I want to say negative results in around 12 minutes. I'm not a medical professional, so don't do anything or use anything based on my word, but somehow it's available only in the US. I think you read somewhere that it's about 6 pounds. And it's not necessarily FDA approved on a normal basis. It got approved because of this emergency use authorization basis. So I'm not sure if it'll be able to be used forever until getting the normal approval, or if it's temporary. But and then again, here's the device, which according to Abbott, still on their website, it can also detect influenza, A and B strep, respiratory thing, serial virus. Yep. Point of care, it's rapid test. And in interviews, their CEO has said that it can be used in pharmacies such as CVS or Walgreens, but ideally it is meant to be used in hospitals and medical facilities. And also, it's primarily, or not primarily, but focused to be used on um, medical professionals because we don't want them getting sick if they're the ones treating the sick people. So, I have one more thing. Think or swim. This is a fun little watch list I made. You can copy, screenshot, save it, use it if you want. But I made this in 2018, so some of these companies may not even exist anymore, or maybe phased out due to buyouts, etc. Nonetheless, Abbott, you can see they're incorporated in 1900, so over a century ago. Yep. Book value around 17, which we already saw their beta. This has a lower than what we saw elsewhere. Cash flow per share dividend, 1.60%. Healthcare industry, now healthcare going supplies. Yep. Market cap $157 billion. Net profit margin 12% respectable compared to all these other companies. You can see the differences if you compare all these numbers. See that they're way better than these are big name companies too. Here's another healthcare, Cardinal Health, Acadia Healthcare. And then price earnings again a little bit higher than normal as you can see compared to the rest. Price strength and tax rate. Also, fingers will notice that these numbers aren't always up to date. I'm not even talking daily. I'm saying sometimes there'll be weeks where the numbers aren't up to date, so don't take any of these numbers for granted. Yeah. Abbott. Yes. So if you buy Abbott, you can hold hands and what the heck is he doing? Tripping her or kicking? Life. Life. To the fullest. What if I want to go beyond the fullest? Healthcare professionals about Abbott. Who we are. Oh wow, look at all these active people. Oh, I know that place. That's in Birch. No, that's okay. How about that glance? Ooh. 107,000 employees. Wow, cardiovascular. Oh look, this dude's swimming. That's a cool set of stairs. Wow, look at all these products. So many products. Consumers. Abbott Labs. I really like this company. They're positioned very well in the healthcare sector, medical devices industry. Don't see too many negatives. The only thing I would say is they have a good bit of debt. They could be taking on risk by if they overspend on COVID testing, research, data, etc. Um, but they do have plenty of cash. Growth is solid. A fair share price. I really like them mid to long term. Possibly even could swing trade them. You can't beat this tagline, I'll say that much. positioned well globally. I do like that they're not entirely reliant of American business. So overall, I'll be honest with you. Um, I was gonna position them a bit lower than I would have thought earlier, but I really like this company. Their numbers are just incredible. Not too much negative to say about them. Um, their new CEO is in a very good position to run the company successfully and build and grow vastly shareholder value. They pay dividends respectively, and unless the world crashes, the world market crashes, um, I see them being positioned beautifully in the markets for a long time. And even if there is a zombie apocalypse, I'm sure that they could be a useful company to citizens. So I was initially gonna place them down, but I'm gonna put them in B. That is not a bad thing. It's an amazing tier to be in. As you can see, there's a safe, like, this is a company you buy and you can hold forever even. You can just be raking in the dividends if you have a large sum of your capital in this company, and I'm sure I would bet on them increasing the dividends in the coming years. I would hope so. If their new CEO wants to get shareholders to believe in him more. So overall, B, great company you can buy and hold the long term. Not A because I don't see huge growth, and not here because, yeah, but solid company to buy and hold long term, respectable, well positioned in the markets. They have a good competitive place in their industry and sector, and I just see great things coming out of them in the future based on their company and fundamental analysis. I don't know. So, yeah. So I was gonna do all these companies at once, but I figured it'd take me forever to get detailed um, rankings of all of them because I can talk about all of them for a long time each. So I figured I'd just do one at a time. And if anyone wants uh, a specific company on this list, of course, for me to review next, I can do so. Any critiques, I'm always willing and open to hearing. You want to make fun of me? Awesome. I'll take it. Room for improvement. I was will never turn down. Is that a double? That's not a double negative. I always will never. I'll never turn down constructive criticism. If there's something that I didn't talk about in the company that you want me to talk about, I'm not gonna go talking about news or specific current events because that just has short term effects on a company, and I'm not basing all these companies on day trading. So mostly for mid to long term value and growth and potential in the markets and investors' portfolios. Yep. So the first stock on the tier list, Abbott Laboratories. Bravo. Safe. I'd buy it, hold it mid to long term, maybe forever. Stay safe.